Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to Retiring Well. Listen, I'm really excited this week because I've got one of my partners, senior advisors at Centennial Wealth named Art Canfield joining me. And listen, he just had a story the other day he was talking about, and I thought it'd be very pertinent to talk about in our show today. And Art, why don't you just reiterate, what was that question that you seem to be getting asked a lot of lately?
Larry, yeah, as we kind of re-enter having meetings here in person again and starting to visit with some folks that, are new to our firm and been with other advisors, it seems to be kind of the leading question is, hey, I'm dissatisfied, my account's lost value, but more importantly, I'm taking income from this thing. I have this nest egg here and I'm trying to live off of this, and my value has dropped substantially and my assets aren't producing the income they once were. And effectively, is now the time to be making that change? And how can I get my income back to where I need it to be to meet my lifestyle?
Yeah. Well, we've talked to folks about this before. Back in the day, when people were in the growth and accumulation phase of their life, they'd be predominantly in equities, right, or stocks. And then when they got soon to be retired, they would move into fixed income accounts or bonds, right, that were paying 6-7% or more. We don't have that today, do we?
That's exactly right, Larry. The case that I'm thinking of here, we have the ability to analyze portfolios, as you know, and we got behind the mutual funds and the various funds that they had, and we learned they kind of had the traditional 60-40 portfolio. They had about 60% in equities and about 40% in bonds. And as we learned, those equities obviously took a hit, and many of theirs haven't recovered, and the dividends had been slashed quite a bit. And then when you looked at that fixed income portion, like you said, back in the day, people would migrate to those because they paid a good interest. They were averaging somewhere between 1% and 2% on these fixed incomes. Once we got behind this, the client had no idea.
Yeah, the amount that they can take out safely from a portfolio like that is not what it used to be. I mean, it wasn't, as a general rule, we used to have what we called the 4 or 5% rule, right? And it wasn't brain surgery, right? I mean, if you had an account that was averaging 5, 6, 7% or more because of the mix of stocks and bonds, and you were pulling 4 or 5% out, well, that worked all day long, right? Because all you're doing is pulling the cream off the top each year. But now, when you got yields so low and equities so volatile, it's really hard to do if not structured appropriately.
Absolutely. When you speak to volatility, that was another concern these people had. Obviously, the income was a huge one because that was their paycheck. But, when I started to go through the risk questionnaire with them and ask about kind of what their comfort level was, and, as we've done, we've talked about the acronym CAN before: capacity, attitude, and need. When we got to that attitude of their risk, these folks only at most wanted to lose about 10%. Which isn't highly uncommon in the with retirees that we work with. But as with it, even with that 60-40 mix they had lost well beyond that and hadn't even recouped back to that starting point. So not only were they frustrated with the income, obviously they saw their almost $1 million portfolio get slashed by over 30% and was way outside their comfort range. So at some point, somebody didn't listen.
Yeah, I agree. Now, Art, you mentioned dividend paying stocks. There's a lot of people out there that say, well, I've got all these stocks and they're paying me a great dividend and I'm using that as income, right? And they think they're safe because they have those, but what's the dangers of that?
Well, I mean, you said it right there. I mean, stock, it's equities. There's not only do the equities inherit their own risk because of the fluctuations of that individual company, but in markets like we're seeing, the systematic risk is huge. The markets are falling, 4 or 5% in days. They're moving around, and then obviously, as we see every headline, it seems like on the various, market news stations, it talks about companies slashing dividends lately to either hold on to the cash they have or because of subpar performances in their quarters.
Yeah, I think what people don't realize is that when the stock market is basically dropping, right, it's because earnings are dropping. And because earnings are dropping, companies don't have as much to pay towards dividends. So, you know, but they think the dividend's always going to be there. I've heard the analogy of like the rental house. You know, what do I care if the house value goes down, as long as it's still paying the rent? That's just like my stock paying a dividend, but it's not true.
Right, right.
In that
I mean,
particular instance, it would be the rent would have to drop accordingly as well.
absolutely. And the example that the client that I talked to that come in to visit with us, their portfolio prior to coming to us, that was a big problem. Their dividends and interest had dropped so much, it wasn't producing the desired income. So what happened? They had to go in and actually sell positions to generate the amount of income they needed. And those positions they were selling were at a substantial discount because of the market volatility. It was
Yeah.
kind of a really a perfect storm for them, and it caused a really negative consequence on their portfolio. They had went from a situation where, more than a couple years ago, it looked like they were gonna their portfolio was gonna far outlive them, to a situation where now they're really in a danger of drawing more than that safe withdrawal rate you talked about.
Well, this is probably a good time to just take a break, but I just want to remind our viewers, if you have a portfolio out there and you're soon to be retired or retired, and you have some concerns about how you're structured right now as you're looking towards having to take income from a portfolio, then I encourage you to give us a call. So stay tuned. We'll be right back. We're going to talk a little bit about high yield bonds, Art. So stay tuned, folks.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
All right, folks, welcome back. Now, Art, we were talking in that first segment about bonds, but I want to specifically talk about high yield bonds, because I'm not sure a lot of people understand what they are. They're basically corporate bonds, right? And they can be, when markets are cooperating, they can act just like stocks. They can be really good, and the yields on them can be much better than what we would call investment grade bonds. But they also come with tremendous risks, don't they?
That's right, Larry. When people hear the term bond, I think so many people kind of naturally lump all the bonds together, municipal bonds, corporate bonds, treasuries. It seems like in many cases they kind of get grouped all in there. But when you kind of get behind the scenes and you look at that credit qualityness, it really starts to separate those out. As interest rates have dropped over the time, there's been I guess, kind of maybe a more demand to go to high yield because it's producing a better interest. But like you said, they come with inherent risk. Think of, a lender as an example. I look at, as I explain these, each one of us have individual credit scores, right? Somewhere between, 800 plus is considered good, down to I think you could probably have a credit score of almost nothing, which as a bank or credit union looks at you as an individual, if they see a low credit score, obviously you're a higher risk to them. So they're going to charge you a different interest rate, most likely, on your loan or a mortgage. When you think of a bond, it's kind of working the same way. Those businesses that are issuing bonds, and if their credit qualityness isn't as good, they're going to have to entice investors to get in there and pay a higher rate. But that default risk, the chance that that company may go belly up, is higher than potentially a more, I guess, sustained large cap sort of thing where it has a better credit rating.
Yeah, I know these credit rating companies have been downgrading, a lot of this corporate debt for quite some time. And, now with this pandemic, I think you're going to see default rates rise. What people don't understand is when default rates rise, banks have to start tightening up their credit, which means less money they can loan out, which has a negative impact on the economy. The other thing, relating to bonds, I think we need to be careful of is many of us are taught that municipal bonds are a safe haven, right? They can't go down because those municipalities or governments have the ability to tax the people to pay the bond, right? But we never saw a situation in the country where so many municipalities are in danger of filing bankruptcy, right? They can't tax the people enough in this particular time to pay the bonds. And look at the city of Detroit, what happened with them?
Yeah, absolutely. I mean, even in today's news, you hear about municipalities, townships, counties cutting projects left and right because of this whole coronavirus slowdown, and because they haven't been able to generate the tax revenue, or obviously the expenditures that they weren't predicting, and it's really put a lot of situations in a tight spot. And the once deemed very, very safe is in question in some cases. Now, obviously not all of them fall into that category. I'm sure there are some very good, but it's just continued. You really have to do your research on these and consider what you're getting into, and making sure you're okay with that risk that you're investing in.
Yeah, I think the other safe haven you'll hear people talk about is what's called long-term treasuries, right? Usually when markets in the past have tanked, there'll be a mad dash for 20-year, 30-year treasuries, and that was considered a safe haven. But what people don't recognize is that we've been in a declining interest rate market for now, 40 years. You can't argue they're at rock bottom now, and they can only go up from here. Now, they may stay down for a while, and Feds can control that. But when they move up, boy, that can put tremendous downward pressure on bonds. I'd like to use the example of, if I have a bond today that's paying 3%, and tomorrow I can get a bond paying 4%, who wants my bond paying 3%, right? Because I'm going to lose that 1%. So let's just say the average maturity of that bond, or that bond fund with all those bonds in it, is 7 years. That's 1% I'm going to lose over 7 years. They're going to discount that bond fund by like 7%, right? Because of that. Imagine being in a 20, 30-year treasury and interest rates even go up by 1 percentage point, right? Well, look what they have to discount it for accordingly. So I think, to say the least, if our audience gets anything out of this, when you're looking at broad asset categories like bonds or stocks, you better know what you're doing, and having a little bit of help with that can be of great value.
Absolutely. I think that's, as you said earlier, that's the importance of having, getting a second opinion. We're happy to sit down with folks, review what you have. Let's figure out what the credit quality of your bonds is right now. I mean, what you invested in may be a little bit different today with the changing economic. I had a situation where some folks come in and visited with us for the first time just last week. And they were surprised to learn they had a significant portion in the high yield aspect. And come to find out, their advisor kind of started to push more of that way, trying to get the interest up because they were taking income. But what they were surprised is, those high yields tend to fluctuate kind of like an equity does. They move a little bit more like an equity versus a bond. And as you said, Larry, with the changing interest rate environment, that we're in now, it's only going to continue to compound this problem. And especially too, as you talked about bond funds, much different than just holding a bond to maturity, because you're getting that price discounting immediately.
Yeah. So Art, I want to break here just for a moment, but I want to pose this question when we come back, because I think this is very important. We've probably, in these first two segments, we've scared people, right? We've given them all kinds of reasons why they ought to be careful in the bond area, they ought to be careful in the stock area. So I imagine their next question is, okay, if there's so much we have to be worried about, what is the solution? What are some things that we can do accordingly? So let's break here, and then when we come back, let's more specifically talk about that. What are some of the solutions we find when somebody's trying to take income, okay?
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
look forward to helping you plan to retire well.
Hi, welcome back. Now, Art, in the last segment, we were talking about, all the dangers of, that people might want to be looking at when they're looking at taking income from a portfolio, why they need to be very careful what kind of bonds they get into, why equities are certainly risky as well. So I'm begging the next question. Folks are probably wondering, well, what are some solutions? How do you take it without having all those risks, right?
Yeah, Larry, it seems like we find far too often people don't plan accordingly for that income, and they have their assets in more of a volatile investment so they're more affected by these market movements. And so one of the ways that I like to explain it, and it seems a very simple approach, is dividing your assets in three buckets. Looking at the first bucket that has basically no risk, it would be in theory, something that was relatively safe. And what I mean that, something that isn't going to be subject to market fluctuations. Think of like a CD as an example. I know interest rates are poor, but you don't have to worry about the downside of the market in a CD-like product. There are insurance products, and they're like a fixed annuity, fixed index annuities that may, for some folks, fit into that. Then in moving into the middle bucket, more of your conservative stuff that might fluctuate some, but has not as much as maybe a true equity where it's going to move around a ton. And then there's some left out there in that growth. This is where we find most people have their assets, but they just have far too much in it, especially right now. You have time on your side, so you can weather some of those storms and hopefully still get some good appreciation out of it while you're taking your income out of those other buckets that aren't being affected as much.
Yeah, I do like that approach because it's like getting a paycheck, right? When you were working and you had your paycheck for income, your investment accounts could be subject to a little bit more risk, right? So in retirement, what you do is you kind of carve out the same thing. You carve out the income, make sure that's safe, and then you can take a little bit more risk with the rest of it, right?
Right. And that's, Larry, I've always not liked this saying because other advisors have used this, but, the old saying is it's only a loss on paper, right? You've heard that over the years, and I've never really liked that saying because it still hurts, right? When you open up your statement every month and if you've lost money, but that's that growth bucket, where you have time on your side. Investing is not only about growth and losses and diversification and all those, there's a multi thing, but it's also about time. And people forget that element far too often when we look at taking income. Income in many cases is immediate. So, you need to plan for that for this month, this year. Now, if you're somebody that has 7, 10 years left, it's probably a different situation. But for those folks in retirement or very near, it's something you have to really consider.
Yeah, and volatility is their worst enemy. I mean, if I'm somebody that's taking 5% from a portfolio and it drops to half its value, and I still need that 5% for income, well, guess what? That turns into 10%. How do I grow it back, right? The other approach I like to communicate sometimes is what's called the laddered approach. If I take, for example, use that 5% rule, right? And so if I carve out 25% of our portfolio for maybe first 5 years of income, and I put that into an investment that's very, very safe, maybe it's only making 1%, right? But it's safe for the next 5 years. And then in another, laddered piece, I take my 6 to 10 year income, which is another 25%, and I invest that in something that can maybe make a fairly decent interest rate for 5 years, then take that out for 6 to 10 years as income, right? Now I've got half my portfolio carved out for the first 10 years of income guaranteed. Now that other half can be in a traditional portfolio that's maybe taking a little more risk, right? Because I got 10 years before I even need it.
No, absolutely. And then also, just as that one, the same thing with the growth and the bucket approach, it satisfies people's, I guess, desire for that growth too. I mean, as investors, people that have been in the market for 30, 40 years, they don't want to just give up all their growth or give up the potential that, what is it, Larry, the FOMO, as you've talked about before, fear of missing out.
Yeah.
When there is good markets, you would like to participate in some of that, but not have it be fully reliant on that.
Yeah. Now, Art, I want to talk briefly about what are called some insurance products. Okay, but be specific. These are insurance products. They're called fixed index annuities. Okay, and then you got variable annuities. Now, on the fixed index annuity side, there's what they call income riders that can be purchased, right? Now, just to give our folks a little background, a fixed annuity is an annuity that's basically that the insurance company is guaranteeing your principal, right? That you can't lose year after year. But if it's in an index annuity, your interest earned is going to be tied to the market. So if the market's up, they're going to give you some varying degree of that market on the up, but none of the down if it happens to be down. So that can be okay in itself, but then you can purchase with those products what's called an income rider, right? And can you talk a little bit about that? What those look like?
Yeah, sure. An income rider can be purchased on top of many different types of annuities, but primarily we see them on the fixed index and the variable. But effectively, you're paying a fee, usually about a percent a year, to guarantee a future income payout. So most companies are going to give you some rise in what they call an income value or benefit base to effectively defer that so many years until you're ready for the income. And then they're going to give you a guaranteed withdrawal rate over your lifetime, or in many cases, joint if you're married, to give you a payout as long as you shall live. Now, the variant thing is where the old immediate annuities, if you passed away and there was still money left, the insurance company used to keep the money. Well, with the riders, the nice thing is if you pass early and there's money still left in the account, your heirs are still in line to inherit that money. But it's just kind of I guess, a predictable way to be able to have that income paid to you, kind of like a pension, if you will, in a way where you have that set monthly distribution coming to you without the concern of volatility in the market.
Yeah. Art, I just want to give a hypothetical so that folks can kind of get a feel for how these work. But let's just take a fixed index annuity with an income rider that says every year it's going to guarantee a growth rate of 7%. And I want to qualify, this is not on the account value side. This is simply on the income rider side. So it's going to grow 7% each year for 10 years. Now, using the rule of 72, that means basically the money's going to double in 10 years if it grows by 7%. So let's say somebody has $500,000 for retirement and they're looking to, carve out some income. Let's say they put 250,000 of that, half of it, in this index annuity. It grows by 7% for 10 years. Now in 10 years, it's worth $500,000, guaranteed, right? No moving parts. And then at that 10-year mark, depending on their age, let's say in this example, it pays 5% out, okay, at that, whatever age they're at. So that's going to be $25,000 a year of guaranteed income for the remainder of their life, guaranteed. So if somebody's looking at, they don't have any pension income, they've got Social Security, they would like to have more guaranteed income so they know their income is spoken for, right? That would be a great way for them to do it. Wouldn't you agree?
Absolutely. If you're somebody that you need that income and need it to be predictable, it's a great method out there. And we've had some clients that have had these over the years, and in times like this, they almost can't be more thankful that they have them, because they see markets fluctuating and they know that their fixed amount of income is coming to them every month. Now, they're not for everybody, and if you're not dependent on income, it's probably something that you wouldn't want to proceed. But if you're interested, it's worth exploring and at least looking at it as an option. It is, like Larry said, it is an insurance product, and remember, there's lots of different variables that come with that. You have to look at the credit quality of the insurance company and many different factors, the fees. There's thousands of these different products out there right now, and it's really important to, I think, do the research or have a firm that's able to do that for you to make sure you're getting a good quality product, low cost, and have those high withdrawal rates down the road, because it's something it's an income product. So you want it to be the highest payout as possible.
Yeah, and the negative being with those products too is that the insurance company wants you to be committed to it, for a period of time. Otherwise, there can be some penalties for getting out. So, but they can be good in certain circumstances. So the other one is I want to talk about is variable annuities. Now they don't have the same principal guarantees on the account value side, right? Because they're kind of tied to the market. They can go down. So don't necessarily like those for that reason, but they also have income riders, depending on the product or the insurance company, that look very similar to the index annuities that can be helpful under certain circumstances.
Yeah, absolutely. I think that those that seem like were very popular in the 90s, and maybe early 2000s, those variable annuities were pitched as kind of a way to still be in the market, but then also have this underlying benefit tied to it in case the markets didn't perform. It seems like though that we find those are riddled with fees and tend to be a little bit more of a, if you want to be in the market sort of thing, but they are appropriate for some people. It tends to be the fixed index to at least offer some downside protection on the principal of the cash value, but they're very complex. I think that's something that, if you are going in this method, it is that they can be very attractive, but it's important. It's important that you have a good understanding of what you had, because Larry, you said earlier, there's some time commitments associated with them. Also, it's important to understand the difference between a cash value and an income or benefit value because of that guaranteed rate. How many times, Larry, have we had somebody come in the office that, that wasn't our client, and they said, well, this is my understanding of this product, and we have to, spend an hour or so saying, well, here's what you actually have. And then they can be frustrated with it. So as everything, I think education is super important with investing and understanding what you have, because there's so many investment vehicles out there, and you have to understand the disadvantages, because as we know, there's no perfect one silver bullet right now that's this great growth with no downside. We haven't found that one yet, right, Larry?
That's right. That's right. Yeah, I'm glad you brought that up, Bart, because there's so many financial instruments out there, and the key for fiduciaries such as ourselves is to educate the client before they engage in these contracts or specific accounts, to know what they're getting into, right? Not everything is good for everybody. So knowing the pros and the cons of everything is going to be highly important when somebody's trying to make that kind of a decision. So I just want to encourage you viewers, if you're somebody out there that maybe has one of those financial instruments and you don't really know what you have, just know that we'd be glad to sit down and educate you on what you have. Make sure that it's still appropriate for you. Let you know what the good and the bad is of those particular accounts that you have. So encourage you to give us a call. If you're somebody that's looking to soon be retired or retired, and you want an income plan, you do have some concerns about what's going on now with this pandemic, and you'd like to make sure that you're structured appropriately, then I encourage you, give us a call. It's a free visit, no obligation. Love to sit down and just talk with you and kind of see if we could be of any help. So the number's on the screen. Give us a call. But most importantly, thank you for viewing today. Look to see you again.